Most trading kind of feels like you're trying to predict the future, right? You're placing a bet on which way the market is going to go. But what if there was a strategy that didn't need a crystal ball? Well, today we're going to break down a really powerful option strategy that puts you in the driver's seat by trading something way more predictable than direction. We are talking about the Iron Condor. No, I mean, seriously, just think about that for a second. What if, instead of just guessing if a stock is going up or down, you could literally choose your probability of success before you even hit the trade button? It almost sounds like a cheat code, but it is the absolute core idea behind the Iron Condor. Okay, let's dive right into this. The very first thing you got to wrap your head around is this huge shift in thinking. See, most trading is all about predicting direction. Is it going up or is it going down? This strategy, it's about something way, way more reliable: the simple passage of time. Every single option out there has this invisible ticking clock attached to it. Part of its price, what we call the time premium, literally gets sucked out every single day as it gets closer to expiring. It's this constant, predictable force that's always at work in the market. Now, if you've ever bought a call or a put option, you know this feeling deep in your bones. You are constantly fighting against that clock, just praying the stock moves enough and fast enough to overcome that daily decay. But what if you could just flip the script? By selling options, you make that decay work for you. All of a sudden, time becomes your best friend. So how do we actually harness this incredible power of time decay? We use a strategy called an Iron Condor. And look, don't let the name freak you out. It's built on a surprisingly simple two-step logic. It's a four-part trade, but it really only does two simple things. First, you define a profit range. You do that by selling two options: a call option way above the current stock price and a put option way below it. This brings cash into your account immediately. Then, and this is the crucial part, you add your safety net. You buy a call even further up and a put even further down. These act as your insurance. And that's it. That combination of selling for income and buying for protection, that's your Iron Condor. And this is the perfect way to think about those options you buy. They are literally your insurance policy. You pay a little bit of premium for them, and you really, really hope you never have to use them. Their only job is to put a hard cap on your risk, making sure some crazy, unexpected market move doesn't turn into a total disaster. All right, enough with the theory, let's make this real. We're going to walk through an actual example using the SPY ETF, which pretty much everyone trades. This is going to show you exactly how the money flows when everything goes right. So here's the setup. We're looking at SPY options that are going to expire in just 1 week. And our bet is super simple. We just need SPY to close anywhere inside this range, between 640 on the low side and 666 on the high side. That's our profit zone. Okay, let's follow the money here. Check out those first two rows. By selling that call and selling that put, we immediately collect a credit of almost $5,000. But we don't get to keep all of it, right? We then use some of that cash to pay for our insurance. Those are the bottom two rows. The money that's left over, that $840, is our net credit. And because SPY did exactly what we wanted and stayed in our range, all four of those options expired completely worthless, and we get to keep that entire $840 as pure profit. So yeah, that winning scenario is great, but let's be real. Anybody who's traded knows the market can do crazy things. So the most important question is always, what happens when we're wrong? This is where the real genius of the Iron Condor structure comes into play. I mean, what if instead of just chilling in our range, SPY just goes absolutely ballistic? Let's say it just rockets way, way past our upper limit. Are we looking at unlimited losses here? Let's find out. So in this nightmare scenario, SPY blows past our range and hits 695. The call option we sold at 666 is now deep in the money, which on its own creates a huge loss, almost $29,000. But this is where our insurance kicks in. That call option we bought at the 668 strike also became super valuable, generating a gain of $27,000. See how that gain almost completely cancels out the big loss? So after you factor in the initial cash we took in, the net result is our maximum possible loss, $1,160. I really want you to focus on this number for a second. That is the absolute most you can possibly lose on this trade. It doesn't matter if SPY went to 700, 800, or 1,000. Our insurance did its job, and our loss is capped. This is what we call a defined risk trade, and it is so powerful because you know your absolute worst case scenario before you ever even place the trade.
Okay, so we've defined our profit, we've defined our maximum loss. Now we get to the most amazing part of this whole strategy. We're about to move from just placing a trade to actually sitting in the driver's seat, where you can literally choose your probability of success.
To do this, we need to know about a little metric called delta. Now, it has a more technical definition, but for what we're doing, you can just think of delta as a quick and dirty estimate. It basically tells you the probability that an option will finish in the money. In other words, that it will have any value at all when it expires.
And we can use these deltas to figure out our odds on the entire trade. The formula is super simple. You just take 100 and you subtract the delta of the call you sold and you subtract the delta of the put you sold. So for our original trade, that gives us a probability of profit of just under 54%.
But hey, what if 54% just isn't good enough for you? What if you want, say, a 75% chance of winning? The answer is incredibly simple. You just move your strikes further away from the price. You give the stock a much wider playground to bounce around in, which, as you'd guess, makes it way more likely it will stay inside that zone. But of course, there is always a trade-off, right? This chart shows it perfectly. Our original trade had about a 54% chance to make $840. To get a much safer 75% chance of winning, we have to accept a smaller potential profit, just $430. It's that simple. Higher odds for a smaller reward or lower odds for a bigger reward. And this right here is the whole point. That choice, it's completely yours. The market doesn't make that decision for you. You do. You get to decide exactly what level of risk you're comfortable with and what kind of reward you're looking for. You are in total control.
So I'm just going to leave you with this one thought. If you have a strategy where you can make money if a stock goes up, down, or even just sideways, a strategy where you can define your exact risk upfront and literally chew your probability of profit, what does that change? If you don't have to be a fortune teller anymore, what does trading even become?